Good morning, and thank you for joining us for today's web seminar. My name is Brian Gamble, Senior Vice President at First Long Island Investors. First and foremost, we hope everyone is in good health and doing well. We have a lot of great information to cover today, so let's get started. I'm joined this morning by some key members of our investment committee: Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer; Ralph Pileski, our President and Chief Operating Officer; and Edward Pileski, Executive Managing Director. A few quick logistical items before we get started. All participants are currently in listen-only mode. After the team delivers the presentation, we will have time to answer any questions submitted throughout the presentation, as well as some we received in advance. Please feel free to submit questions as we go through the presentation by using the Q&A button on your screen. At this point, everyone should see a slide with today's speakers, which I'm switching to right now. If you're not seeing that, please let us know and by typing something in the chat area, and we'll try to troubleshoot as we go along. And finally, our general counsel always asks that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. I'll now hand it over to Bob.
Thanks, Brian. Next slide, please. Our agenda today will be a discussion of the current markets, inflation, the Fed, the U.S. economy as we see it, the 2023-2024 wall of worry, our approach to the current environment, summary, and then we'll have some Q&A. Next slide, please. Let's state the obvious. If there is one thing that's certain in business, it's uncertainty. Stephen Covey, author, educator, and business person. And whether it's the economic environment, domestic politics, geopolitics, even war, we as investors always live with uncertainty. Next slide, please. Despite uncertainty, however, long-term, prudent, careful investing pays off. However, not all investments are equal in return or risk. And as you can see from this chart, despite last year, where we had a 10-year bond down almost 18%, and the S&P down almost 18 or about 18%, 3-year annualized return and 5-year annualized return for the S&P 500 and NASDAQ were very positive. Bonds didn't do so well, and cash was a de minimis return, especially when net of inflation. So if you look at the chart on the left, and you see those nice colorful lines, you'll see the flat line is the Bloomberg 1 to 3 month T-bill, which has finally woken up a bit. And you can see that the green line, the NASDAQ composite, and the S&P 500 did quite well. The Dow Jones, which is somewhat of an antiquated index, did not do nearly as well. But again, the key point, over the past 1 3/4 years, all markets, bonds, equities, real estate, and private equity have been volatile based on inflation, interest rates, a COVID hangover, and now 2 wars in the world. But nevertheless, through October 20th, 2023, if you invested for the long term, either 3-year or 5-year, you did pretty well. Next slide, please. Now, what's unique about this market this year, although not unique in the past, is that if you don't have proper diversification, you may not participate in market gains. And what this chart is showing is that growth currently is dramatically outperforming value. Last year, value type investing outperformed growth. So at First Long Island, we have our clients exposed to both growth and value. And quite candidly, this year, they're renaming the S&P 500 to the S&P 493. 7 growth companies have been driving market returns. And if you extract those 7 growth companies, and I think you all know what they are, if you extract those 7 growth companies, the rest of the market is flattish to even slightly down. So it's important to be diversified. And you'll see later on in our presentation, we provide diversification to our clients among what we think are the best growth and value companies out there. So our clients are always participating. Next slide. Now, as you can see here, we're approaching a presidential cycle next year. And already you're reading about a lot of the candidates on the Republican side. And of course, President Biden has announced his desire to run again next year for a second term. What we're trying to point out here, and this is historical, it's not a guarantee, it's a guide, but over long cycles, these years have mattered in the presidential cycle. So we're in year 3 right now, where the average over many, many years since 1961 has been a 16.7 gain. And we're somewhat below that at this point, again, driven by some growth companies. And the forecast for next year historically would be an 8% gain in the S&P. Pretty good. But again, this is historical information, and it's not a guarantee. Next slide, please. Now, what we at FLI rely on, and you've heard this for the 40 years that we've been in business, and as you know, we're celebrating our 40th anniversary this year, what we rely on are earnings, which are projected to be positive this year, next year, and actually in 2025. At this point, those who are predicting a recession this year have now withdrawn that prediction. We have never been in the camp that this year would be a recession. It's possible the end of next year, there could be a slowdown in the economy, but nevertheless, based on consensus estimates at this point, we see a trajectory of improved earnings. And to some extent, AI may be part of that and reflected in some of the companies that make up these projections. But again, what's very important to us at First Long Island as a key component to appreciating your wealth in the equity markets is the trajectory of S&P earnings. And our job is to find those companies that will certainly meet these estimates, if not exceed them. Next slide, please. Another key factor to investment success is the level and direction of inflation. Here are 2 indices that are very, very closely watched by the Fed and by us as investors. And this reflects what has been the issue in the last year or so. As you can see, during COVID, inflation came down. If you look at both of these charts, and then you can see there's a spike of inflation, which we have all felt. However, most recently, that inflation has come down. And as you can see in terms of CPI, it's now 3.7%. And at one point, it was near 9%. And then the PCE, which is what the Fed watches more closely, it's down to 3.48%. So again, this level of inflation, not quite at the Fed's target of 2%, which is sort of arbitrary, but nevertheless, that's their target. We've come down dramatically, and we believe that inflation will continue to come down. But these are key factors in terms of interest rates and how equity markets will ultimately do. Next slide, please. Now, the Federal Reserve are forecasting rates projected to be higher and remain higher for a longer period of time. We believe we're at the peak or near the peak at this point. Perhaps there may be one more increase. We would hope there would not be another increase, as there's a lag effect to interest rates and their impact on the economy. But as you can see from the yellow, the green, and the orange, or whatever color that is, a red dot, the trajectory is for rates to come down, the Fed fund rates to come down, which is positive. If the economy slows sufficiently, rates will decline a bit faster. But what is encouraging here, after having years of virtually very, very, very low interest rates in the Fed funds rate, we now have a bigger buffer. And if a recession does come, the Fed is in the position to cut rates and help the economy. But again, let me make this clear. We're either at the peak or very near the peak of the Fed funds rate, and that's good news for investors. Next page, please. And this is an interesting slide. It's the Fed funds target rate, upper bound, and CPI at the end of prior tightening circles. So what does this mean? The Fed funds rate tends to peak while inflation is trending down. So if you look at the slide and you see the dark blue, which is the Fed funds rate today, is 5.5%, and you look at the CPI at 3.7, and you look at prior cycles, whether it's 12-19, 2018, or back to 2006, these tended to be the peak of Fed funds rates because inflation is declining. And by the way, if you look at the 5.5% of the Fed funds rate, this historically is very tolerable. I mean, here we have 5.5. Yes, we did have 2.5, which was an anomalistic period of time. But when you go back and you look at 5.3, 6.5, 6, 9.8, 11, oh my God, 20% and 13%, you see that Fed funds rate have been much higher than we are today. So again, at 5.5%, although it's higher than it's been, and that's causing some anxiety among certain investors and companies, at 5.5 is, we believe, quite tolerable and is trending down. Next slide. This is the Fed balance sheet. And as you can see, it mushroomed because of COVID. If you look to the extreme right, there was a little bump up in the Federal Reserve's balance sheet for the mini banking crisis in March. And that's when certain banks went out of business, led by the one on the West Coast and Signature most close to home. But the Fed has again started to taper its balance sheet, which means it's not buying securities in the bond market. And this is actually healthy and starting to contract after supporting the economy and markets for 3 years, particularly because of COVID. It really bailed the economy out rightfully, although perhaps it went a bit too far. And as you can see, there are other points in time. March 20, COVID stimulus starts. Fed really increases its balance sheet well above what it's been historically, and now we're starting to come down. So when you think of interest rates going up, and you think of the Fed no longer or letting its securities mature and not buying new ones, this is all part of the tightening cycle that we as investors are facing and businesses are facing. Next slide, please. This is another key slide to look at because this is the US 10-year real yield. And what does that mean? It's the 10-year Treasury bond minus the year-over-year CPI. So for the first time now in several years, there's actually a real yield of 1%. Now, real interest rates are modestly positive for the first time, but is it anything to boast about? You know, the 10-year Treasury minus inflation being 1%, a real yield above inflation, that's not enough to grow your wealth after inflation on a real basis. So in our opinion, this suggests with a reasonable asset allocation that our clients should have exposure to asset classes which will generate more than a 1% real yield after inflation. Next slide, please. This is one of my favorite slides because, as you can see, it's rather dramatic. And this is the M2 year-over-year change, monetary supply. And M2 is the US Federal Reserve's estimate of total money supply, including all of the cash people have on hand, plus all of the money deposited in checking accounts, savings account, and other short-term savings vehicles. Why this is so important is because, in our opinion, it really tells you where inflation is going when this monetary supply is being sucked out of the economy. And as you can see, having a negative 3.7% is almost unprecedented. I think you have to go back to World War II to see something like this, or before then. So obviously, the money supply grew during COVID to help the economy. It kept alive a lot of businesses that I like to call zombie companies, those that were able to sustain their existence based on borrowing money at 1 or 2%. And now that money's not available to them, or if it is available to them, it's at a much higher interest rate. But as you can see here, this tremendous drop from a growth in monetary supply of 26.9% to a negative 3.7%. In our opinion, this is something that indicates inflation will continue to come down. And also the economy ultimately might not be as robust as this money supply is not sloshing around in the economy. And with that, I will turn it over to my partner, Ed.
Thank you, Bob. I'm going to spend some time on the U.S. economy and some of the pillars of the foundation that is really providing the strength within the economy. And let's start with the U.S. consumer. The consumer spending plays probably the most important role in driving the economy. It accounts for a significant part of U.S. GDP, about 70%. Thus, the health of the consumer is vital to the progress or health of the economy. Consumers' finances and balance sheets have improved and remain healthy as savings and net worth are at elevated levels, having significantly risen since the pandemic. The chart on the left shows the excess savings by U.S. household savings. And you could see that the pre-pandemic, the consumer had little excess savings. During the pandemic, the consumer's excess savings began to increase, peaking in the middle of 2021 at around 2.3 trillion. It has since steadily declined, likely due in part to inflationary pressures, but remains at a high level. The chart on the right shows the households and nonprofit organizations' net worth. This chart shows that consumers' net worth has dramatically increased since the chart's starting point in 2000, from about 44 trillion to currently about 151 trillion in 2023. Increased wages, rising home prices, and increased equity valuations have significantly contributed to the rise in household net worth. Next slide, please. This chart on the left shows U.S. non-farm payroll employees versus the unemployment rate. And I think the key here is that a solid driver of the economy has indeed been the strength in employment. The chart shows that the unemployment rate, which is the red line, which currently remains near the lowest in decades, the unemployment rate has fallen rapidly since late 2020 and has since consistently declined to around 3.8%. This is in sharp contrast to the bleak reality of the high level of unemployment that existed during the early stages of the pandemic, in which the unemployment rate peaked around 15%. Non-farm employees is represented by the vertical blue bars, which has been steadily rising, reflecting the improvement in the U.S. employment. The chart on the right shows job openings over unemployed ratio. This chart displays the ratio of advertised job openings, known as JOLTS, to the number of unemployed workers. There were 1.51 job openings for every unemployed person, which is down from the recent all-time high, but well above its pre-pandemic high of about 1.2. The JOLTS data serves as a crucial barometer for assessing labor demand. It also reveals that any disparity between workforce demand and supply could potentially exert upward pressure on inflation. The latest data reflects a resilient labor market, while the overall trend in job openings continues to exhibit a sustained decline, which began in early 2022. Let's move on to housing. The chart on the left displays the S&P Case-Shiller Home Price Index, and this is the percentage change year to year. In recent years, the housing market has been strong, driven in part by low mortgage rates, tight supply, and demand fueled by people moving to warmer climates, and also moving from multi-family buildings to single-family houses. The S&P Case-Shiller Home Price Indices are the leading measures of U.S. residential real estate prices, tracking changes in the value of residential real estate nationally. And you can see the home prices have soared since 2020 and continued until early last year, up until increased mortgage rates led to a decline in the growth of home prices. Currently, home prices have plateaued with the year-over-year growth around 1%, 0.96, still appreciating, albeit at a much slower rate. Prices are rising again in part because supply is still very low. The chart on the right displays single-family homes sold versus the mortgage rate. The chart shows that the number of homes being sold is declining, reflecting decelerating growth. This chart reflects the inverse correlation between the number of homes sold, which is the solid blue line, and the 30-year mortgage rate, which is the dotted red line. It's apparent that when interest rates fell from 2018 to early 2022, the number of homes sold dramatically increased. As you could see with the rise in rates, the number of homes sold materially declined. Current homeowners are reluctant to sell, given that most are paying mortgages rates that are less than half of today's rates. On to the next slide, please. The chart on the left displays the Tier 1 risk-based capital ratio. The banking system Tier 1 risk-based capital ratio is important. The Tier 1 capital is the core measure of a bank's financial strength from a regulatory's point of view. The Tier 1 capital ratio is the ratio of a bank's core equity capital as compared to its total risk-weighted assets. Having recovered since the financial crisis of 2008, you can see that it's now tracking near recent highs, indicating continued strength. On the right-hand side, the chart on the right displays manufacturers' new orders, non-defense capital goods excluding aircraft. This chart displays manufacturers' new orders fell significantly during the pandemic. It's now improved to the highest level since the start of this chart, which began in 2011. The continued strength in manufacturers' new orders reflects the resilience of business investment and is one more reason we remain optimistic about business conditions supporting the economy. On to the next slide. The wall of worry refers to a tendency in financial markets for stocks to rise in the face of headwinds or concerns facing the global economy and the investment environment. There's been no shortage of blocks that comprise the wall of worry for 2023, 2040, 24, which include the following. You have inflation, you have the Fed monetary policy, mortgage rates, and housing affordability, the potential government shutdown, government spending, deficit levels, geopolitical risks, energy prices, labor strikes, the presidential election cycle, and the potential for a recession. We believe markets will ultimately climb the proverbial wall of worry, even if it takes some time. The main step in dealing with the wall of worry is to recognize its existence. Market cycles are inevitable, and periods of uncertainty and volatility are bound to occur. By acknowledging that the wall of worry is a natural part of the market landscape, investors can be better prepared mentally and emotionally to deal with these blocks within the wall of worry. When investing for the long term, one of the biggest challenges is to see through the clutter of headlines that are blaring and leading to this market volatility. The key is staying invested through the uncertainty, which has typically served our clients well over time. And we remain disciplined, seeking to take advantage of market dislocations to invest in quality companies that can deliver consistent earnings and dividend growth over the long term. I'll now pass it to Ralph to talk about the next slide.
Thanks, Ed. This slide is fairly familiar to everyone, but for our newer clients, basically, we have always preached that a diversified portfolio with a prudent asset allocation is how you should manage your money on a long-term basis. And we do it in 4 different baskets. To the left, you have cash and fixed income, which we are modestly underweight right now with a focus on quality, and I'll get into that in the later slide. There's some defensive strategies, dividend growth being the lead in that category, and we'll touch that on another slide. And we're overweight that category right now because we think the market will be moving toward that category in 2024. We're modestly underweight the traditional equity bucket, and as Bob had mentioned, there are 7 magnificent stocks that have driven the gains this year. The other 493 stocks are pretty much flat to down. And then there's private investments and with a concentration here on real estate. So we utilize that as appropriate. It's not a big portion of someone's net worth, but it's has delivered some pretty good returns. Next slide. As everybody's been reading and everybody's been seeing that the yields in the fixed income area have risen recently. So we just wanted to show you a comparison of what it was a year ago versus what it is today. And this is as of October 20th. The solid gray bar is the net after-tax yield on a 3-month treasury, a 5-year, 10-year, a 5-year muni, and a corporate investment grade corporate bond. So you can see that solid gray bar, and above the solid gray bar is the pre-tax yield. What has happened in 2023 is those yields have increased, both on an after-tax basis and on a pre-tax basis. And in some cases, significantly increased, as evidenced by the 3-month treasury. So you probably have a little over 5.5% return in a 3-month, 4-month treasury right now. That's a pre-tax return. So just keep that in mind. But you can see what has happened to yields. And we have taken the stance that we're probably going out a little bit on a duration because we think that eventually sometime in 2024, probably in the latter half of the year, the Fed will be cutting rates, not increasing rates. Next slide. This is our dividend growth strategy, and our dividend growth strategy was predicated on if you look to the chart to the right, the Gordon growth model. And Myron Gordon was a professor in the University of Toronto, and his theory was that if you take a current dividend yield and the increase in that dividend over time, that will be your return. So you can see with a 3% dividend yield and a 9.3% dividend growth rate, you get a 12.4% return. Our dividend growth strategy, if you look at it over a 12-year period, it has done a 10.8% net to the investor, which is pretty good. You can see the yellow line is pretty much risen and has really been rising in the last couple of years. But you can see the solid blue line, what the increase in the dividend has been over that same period of time from 2011 through 2023. Next slide. This is something that's fairly obvious, I think, to most people, but if you look at what a 90-day treasury has done from 1997 through the current time in 2023, if you invest in $1 million in a 90-day treasury, you're sitting with $1.6 million right now. If you put that same $1 million into a 10-year treasury, you have $2.3 million. And if you took that $1 million and just invested in the S&P index, you'd have $7 million. So equity investing over long periods of time, in my humble opinion, is where everybody should be. Even given the volatility that you have to go through sometimes, like we did in 2022. Next slide. Our approach is pretty simple. And I've had many conversations over the years with many clients saying, well, maybe we should just take our money out of the market for a couple of months and just sit on the sidelines. And it's pretty tempting when treasuries are where they are today, a little over 5%. But this chart will show you that if you missed, now this is 28 years So in those 28 years, if you miss the best 50 days in the market, you have a negative 1.2% return. That's the number all the way to the right. So if you miss the best 40 days, you barely broke even. If you were fully invested over that same period of time and never made any timing moves, your return was 8.1%. So this is pretty graphic when you take a look at this, and it really convinces me, and hopefully I will be able to convince clients, you got to stay invested. You got to cut out the noise in the market. I've always told my clients, and they know, those who know me for a long time, that I only worry about two things. I worry about interest rates and earnings. And interest rates sometimes will cause you a headache like they did in 2022 by going up 525 basis points in 1 year. That doesn't happen. Maybe once it happened in the early 80s, but it hasn't happened in a long time. And the earnings, on the other half of the equation, the earnings have been pretty solid and remain solid. And if we're picking the right companies, and I'm not talking about the overall market earnings, I'm talking about the earnings of the companies we own. Those earnings are fairly predictable. We have companies that are high quality, they dominate their industries, credible managements. And when you have that combination and interest rates are reasonable, and even though interest rates at 5%, I can tell you that in the early stages of our history, interest rates were historically always 5% or greater. So I'm not worried about interest rates where they are right now. And I don't think they're going to remain that way for a long time. Probably second half of 2024, you'll see some come down in interest rates. Next slide. This was an interesting chart that we saw recently, and this is an S&P index return. And you can see in this slide, now you're talking about 97 years. In 97 years, the market has been down 10% or greater only about 11 times, 12 times out of 97 years. The market also, if you look at the other end of the spectrum, the market's been up 36 times in those 97 years, up 20% or more. And another 21 times, 10% or more. So again, it's a commercial for equity investing. And I believe in what we do. I believe in the theory of buying high quality companies with predictable earning streams. And this chart will show you that. Next slide. This is something that we've followed for 40 years. All right. And it's the comparison of the earnings yield on the S&P 500 to a 10-year treasury. And the red line being the 10-year treasury and the blue line being the earnings yield. And you can see back in the early days, the earnings yield on the 10-year treasury, or the yield on the 10-year treasury, I should say, not the earnings yield, was historically higher than the earnings yield on the S&P. And it started to cross around 2002, 2003, and you can see that the earnings yield has now, over 20-something years, has historically been higher than the 10-year treasury, and it's still the case today. So what it basically is saying is that you are better off in the equity market than you are in a 10-year treasury. Bear in mind that I've had clients talk to me about, well, you know, treasuries are 5% now. I said, okay, it's 5%, and you're going to buy a 10-year treasury, and you're going to get 5% over 10 years. You're not going to need more than that, and that 5% is taxable. If you invest in dividend growth, which we showed you on a previous slide, you're going to get a current yield of somewhere between 2.5% to 3%, and that dividend is going to grow somewhere between 8 to 10%. So you're going to end up with closer to a 10% return, and it's going to be more tax efficient because most of it will be tax capital gains. So in my mind, there's really no comparison over very long periods of time. Next slide. Okay, I'm going to turn it back to Bob, and he's going to go through, conclude this with some summary.
Thanks, Ralph, and thanks, Ed. Despite the significant downturn last year, the U.S. equity markets have provided strong results over the long term, including the past 3, 5, and 10 years. With approximately 17% of S&P 500 companies already reporting for this quarter three, earnings are forecasted to grow modestly in 2023 and more robustly in 2024, as we showed you in a much earlier slide. As Ed pointed out, the economy is doing reasonably well. Unemployment remains low, although we expect it to eventually increase, and inflation has continued to trend lower, but it's still impacting certain businesses, some more than others, as well as consumers. The continued Federal Reserve actions, combined with still elevated but declining inflation, are in part driving current uncertainty. How high will rates go? How long will they stay there? But as we pointed out, a 5% 10-year interest environment is nothing that we're terribly concerned about, with the 10-year being at 5%, although we expect it will trend down over time. Excuse me. The ongoing geopolitical hotspots, and I'll reverse this and start with Israel and Gaza first, Russia, Ukraine second, China, and of course, Iran, as well as our own political divisiveness in Washington, need to be watched and will cause volatility from time to time. But that's been the case over the many years that we've been in business, which is now 40. Next slide, please. We believe being patient with a prudent asset allocation that is overweighted, as Ralph pointed out, to the defensive strategies, while modestly underweighted to fixed income and traditional equities, is the best course for most investors at this point, excuse me, to prudently grow your wealth over the long term under the current economic circumstances and geopolitical circumstances. Maintaining enough cash and high quality short-term fixed income, earning a higher rate of interest to sleep at night, is part of a prudent, diversified asset allocation. Concentrated portfolios of companies with strong fundamentals and managed with a focus on quality, I emphasize quality, and secular growth trends, excuse me, and or growing dividends should prove successful over the long term. Reviewing your overall wealth management plan with an eye towards understanding the tax, charitable, estate planning, and insurance options is a critical step, and one we can help with in conjunction with your accounting and legal professionals. And with that, I'll turn it over to Brian to address Q&A, please.
Thank you, Bob, and thank you to all our presenters for sharing all of this with our participants. We'll now begin answering questions and questions from our audience, and we have gotten some great questions already. Please continue to send your questions over, and we'll get to as many as we can. So first question is, with interest rates at high levels, how long do these rates stay there, and do they have a propensity to go higher?
Well, I think I presented a slide or several slides earlier that show, in our opinion, interest rates really trend with inflation. And inflation is coming down. Interest rates have reached a higher level where they are now, but we were spoiled. If you go back over the 30, 40, 50, 60 years, the 5% 10-year treasury was normal. We saw it at less than 2% at one point several years ago, and that's abnormal. So the interest rates will trend with the economy, with inflation. We expect that longer term, they will trend down. But for right now, with the Fed target being 2% inflation and still the economy being over 3% inflation, rates may stay higher longer. But again, we want to emphasize, that a 5% 10-year treasury, the 5.25, 5.5 Fed funds rate, this is not historically abnormal, and it's something we as investors can live with.
Thanks, Bob. And we have a follow-up question to that. Bob, you had mentioned that it's going to follow inflation. So what needs to happen for inflation to get down to the Fed's 2% target?
I'll take that. The 2% target is an arbitrary target that the Fed has established over the years. there's nothing to say you can't live in an environment where inflation is 3% or 2.5%. I think it's going to be extremely difficult for the Fed to get down to 2% based on oil prices, and the geopolitical stuff that's going on. The commodity prices, there was a huge problem with shipping at one point in time that seems to be abated. But I think the Fed at the end of the day may have to adjust their 2% target a little higher. And everybody would be, if they did that, everybody would be comfortable with that. And we could live with that. So the way to get it down basically is you've got to have, it's crazy because a bad economy is good news for the stock market at this point in time, because that would make the Fed start to reduce rates. I don't see that at this point in time. I see the Fed keeping rates higher for at least another 6 to 9 months. And then possibly if the economy does start to weaken, as Bob mentioned earlier in the presentation, there were a bunch of economists who were predicting recession in 2023. Well, it didn't happen. And it may not happen at this point in time. Now, we'll see what happens next year, but there are a lot of things that can drive it one way or the other. But the 2% inflation target is an arbitrary number. And the Fed is really going to have to make a decision in 2024 as to what they're comfortable living with. And the old adage of don't fight the Fed, well, it's pretty true. And, that they really destroyed the market last year by doing what they did. They're doing a decent job right now in preempting a lot of the conversation by the conferences they have. And every time Powell speaks, the market goes down. But I'm not sure what more they can do other than keeping the rates higher for longer to get that inflation number down.
Yeah, let me just add a few points to what Ralph said, and I certainly agree with him. Inflation is a cruel tax. And we'd all love to see inflation come down, and whether it's 2.5, or 3%, to Ralph's point, that's a very tolerable level of inflation. The economy remains robust and resilient because of the point that Ed made with employment. When you have 3.8% unemployment, which is a very low level, you have all these people working, all these people earning money, and the desire to spend, it tends to keep inflation a little bit higher. Wage growth has also been a contributor to that. On the other hand, Ralph made the point about the supply chain disruptions that we saw during COVID. That created a great deal of inflation. And that, to a very large extent, is behind us. And productivity, automation, AI, artificial intelligence, these are things that can reduce inflation over time. So there's a lot of complexity to the current economic environment. But the fact that we have good, robust employment is a positive. That takes recession off the table for the time being. Fed keeping rates higher, that will stifle some demand. So I think we're going in the right direction. We've got a robust economy, resilient economy, I should say. Yes, we are concerned about the wars going on, which, by the way, will contribute to certain elements or parts of the economy, particularly the defense sector. So we're looking into that to see if there's anything worthwhile investing in that sector. But inflation is coming down. The scarcity that we had during COVID is behind us. I think that productivity is improving. On the other hand, wage growth is going up, although there's been some weakness that we've seen most recently. So let's expect rates to stay higher for longer, but the level of rates is tolerable and inflation is coming down. But who knows if it ever hits the magic number of 2% again.
One further point. The one real big factor that kept inflation low was globalization. And you had the United States moving manufacturing to China, to India, to Vietnam, to countries all around the world. That's changing. All right. There's going to be more manufacturing done in the United States. If more manufacturing is done in the United States, that's going to be inflationary because it's going to be more expensive to manufacture things here than it is in China or Vietnam or any other place. So that's a factor going the other way that may keep inflation higher for longer. And it's a couple of years out because they're building chip plants in Arizona, they're doing things in Texas, and the more you bring back here, especially with the union situation and everything else, it's going to be much more expensive to manufacture things here than it is now. Will AI, which is the topic of the day, create better productivity? I believe it will, and that could be an offsetting factor. But you got to keep your eye on the globalization or the deglobalization now, and because that could be a swing factor.
Thank you, Bob and Ralph. Staying with the theme of the economy, housing affordability, student loan repayments resuming, and a still elevated inflation level, which we just discussed, point to a weakening consumer. Is this a concern for the economy, and are we close to recession?
No, I'll take this one. I mean, listen, there's no doubt in the slide I presented earlier that the consumer is the engine of GDP, being 70%. And there's no doubt that their savings, the consumer financial balance sheet and their savings, they're in a pretty good position. So I think with wage increases and unemployment being low, that engine will continue to drive the U.S. economy. As it pertains to a recession, I think, for much of last year, the recession fears have been building against a sharp rise in interest rates and market uncertainty. And we talked about the wall of worry and how those are real fears, but the markets often climb that proverbial wall of worry. I mean, only recently there's been a shift in sentiment. And I think given the resiliency of the U.S. economy, we talked about employment, we talked about housing, we talked about consumer spending, a growing amount I think of investors are seeing that there's an increasing likelihood that there's going to be a soft landing where the Federal Reserve can raise rates to combat inflation without triggering a recession. And I think that's the cautious approach, but I think a soft landing is inevitable. And I think the Fed can deliver on that. Bob, Ralph, I don't know if you want to add to anything.
I'll add a quick something to what Ed said. People and businesses are pretty smart. So when many homeowners saw mortgage rates at 3% or less, they refinanced. So they're not in the marketplace right now at 8%. Many smart businesses that saw the need for borrowing longer term took advantage of the incredibly low interest rates and locked in longer term rates. We as an investment committee look at every business that we invest in, or virtually every business that we invest in, and we take a look at what their debt payment schedule is to see when they have maturities, when they would be facing higher debt, and do they have sufficient cash flow to retire that debt so that they don't have to borrow at much higher rates. So the good news is smart homeowners refinanced. That also takes them out of the market to move, because why give up a 2.75% mortgage or a 3% mortgage to move and take on an 8% mortgage? So that may reflect on the housing activity. And smart businesses have gone out and borrowed where they needed to for the longer term. So you take a look at that and you say, yeah, there's some inflation, but those businesses that have gone out and borrowed money, they have the ability to invest in productivity endeavors that will offset some inflation and keep them growing for the future. So we are cautiously optimistic, to be candid.
Thank you, Bob and Ed. Okay, next question. What are the implications of the Gaza conflict and increased geopolitical tension? Is this likely to cause or contribute to a recession? Do you think U.S. equities will outperform international equities?
Oh, I'll take that one. As you know, we have, and every Tuesday morning, except for today, because we're going to have it later in the day, we have our full investment committee meeting. We have 9 people on the investment committee. We all show up in our conference room. Now it's post-COVID. And we look at the various markets, and we track international investing since actually December 31st of 2007. And it's dramatically underperformed the S&P and the NASDAQ. So in our strategies where we do have some equity, international equity exposure, it's at a very modest level. So we have never been huge asset allocators to foreign markets because we like the certainty of accounting domestically, and many of the domestically housed businesses or domiciled businesses that we invest in have international investing as part of their sales and earnings portfolio. So the war in Gaza is terrible. The attack, the brutal ISIS level massacre that took place on October 7th certainly has raised the specter of a regional conflict. In the past, if you look at history, at least I believe, and I say I believe because I don't have a formal chart on this, that regional conflicts, when it did create volatility in the equity markets, was actually an opportunity to invest in good businesses for the long term. So I believe that to be the case. I don't have a slide to present that, but I think if you go back and look at regional conflicts, you'll see that. In terms of the economy, I mentioned earlier that these hotspots in the Ukraine, which is a war against Russia, and now Israel defending itself against the terrorist organization Hamas, and the other Iranian proxies that are terrorist organizations, Hezbollah and Islamic Jihad, is forcing the United States to supply weapons and armaments to its allies. That actually will produce good business for America while it's helping our allies to defend their democracies. So at this point, as long as the conflict remains very regional, which it is thus far, it shouldn't be that disruptive to our domestic economy, and it shouldn't be that volatile to the equity markets as we see it. Matter of fact, if you look at the equity markets the last 2 weeks, they certainly, knock wood, haven't gone down dramatically because of the conflict that we're fighting, or not we are fighting, but Israel is fighting with our support against this terrorist organization. And even the conflict in the Ukraine, which we continue to support, again, not with troops, but with armaments, has not led to great volatility. To some extent, we are watching the oil markets, and we do have some exposure in the oil markets in the event any of these conflicts create a supply shortage, which would be unfortunate, especially since the U.S. has the capacity to produce more oil and gas, and maybe that will happen over time. I hope that answered the question. You know me, I'm somewhat long-winded, but it's a very timely question.
Thanks, Bob. And that was the last question we'll have time for today. On behalf of the entire FLI team, I would like to thank everyone for joining us, and I hope that you all found the session interesting and insightful. If you have any friends or colleagues who you think would benefit from joining future events like this, please let us know, and we would be happy to include them in the invitation list. For our clients on the line, I'd like to remind you that our investment committee is always available to discuss your individual asset allocation. Please just give us a call. Have a great day.
Yeah, if we didn't answer any questions, don't hesitate to call any of us.
Thank you.